welcome to today's live. As you can see, I'm live on YouTube too. Wow, check it out. Live on YouTube, exciting. And live on Periscope. Thanks for being on the live, guys. So appreciate you. Let me flip the screen here eventually. There it goes. Okay. Nice to see you guys. I forgot to put my live on my blog, but while I'm doing that, I'm going to tell you my story. My name is Maisel Bilal. Thank you so much for being on this live broadcast. I really appreciate you all. Thank you so much for being here. And I just want to say that I live in Honolulu, Hawaii. Hi, Memba. Welcome. And I'm actually living in Waikiki. So after I do on my live broadcast today, I'm going to go surfing. Yay! One of my favorite things to do is to go in the ocean here. And it is a beautiful place, Hawaii. So I highly recommend visiting if you don't live here already. It's just awesome. So I want to talk a little bit about who I am and why I'm doing a broadcast about investors and all that kind of thing while I am editing this blog post. So my name, like I said, is Maisel Bilal. I have my husband his name is Jamal, and my son, he's 6 years old. He just turned 6. Oh my goodness, he's 6. It's amazing. Anyways, what happened? When did it end? Sorry, my Periscope ended. Anyways, I will do that again. But so I used to work at a bank here back in 2009, 2008, around then. And at the time, I started getting into a lot of debt. And it was mostly credit card debt. And so I ended up having over $40,000 of debt, which is a lot, you know. And what I did was I decided to focus on investing and creating passive income instead of focusing on sorry, I'm losing my train of thought. Instead of focusing on the debt, I focused on paying it off. Okay, so by April of 2016, I paid off all that debt, right? But I not only focused on paying it off, I also focused on creating passive income, right? So I didn't have, it's depressing to look at debt, okay? And I learned from many teachers of mindset that you get what you focus on, what you think about will grow. So if you're always thinking about your debt, you're just going to get more debt. Now, if you start thinking about other things like your wealth, right, stuff like that, then you'll get more wealth. So I started doing that. I started thinking more about wealth and prosperity, and I focused on how can I make investment income, right? And I started out, I still have dividend yielding stocks. When I married my husband in 2012, he didn't have any passive income except for a savings account, but that was making 0.01% or whatever it was at the time. And so he also had more debt than me. He had a house that was underwater, car loan, and he had some credit card debt. So the amazing thing, though, is we went from a negative 6-figure net worth when we got married to positive 6 figures by 2016. So by the time I quit my job that year in December, we had improved our net worth by $500,000. And we were making passive income of about $500 a month. And I started coaching Finance Freedom members. So that's my basic story. 2017, we went on 1 month's worth of vacation. We went on a cruise to the Mexican Riviera. We visited my sister in Washington, D.C. and our relatives in Canada. We went to Niagara Falls. We also visited LA And yeah, it was fun. And I hadn't taken that much time off in forever, like since I was a student when I was in school. So that was so cool. And that year we also bought our first home. My husband had bought one home prior, and that was the one that was underwater. He had to short sale it, so he didn't own any property after that. And he was kind of wary, very wary of buying property after what happened there. So I had never bought property. I had that goal since 2011, at least. Because in 2011, I did a financial analysis, and I owed over $40,000 in 2011, and I wanted to buy a place. And my debt service was really high. I was paying over $1,000 a month just to pay off all those loans I had. So I had this dream of owning property, just didn't know if I could. In 2017, we bought our first condo together, Mikey P, and we moved in. And then in 2018, we bought our second condo as an investment. So that's an Airbnb business. My mother is running that. She manages and cleans it, and we pay her for that. So I employed my mother in a job so that she has stable income. For the elderly, older people, sometimes it can be challenging to find a job. But I got her that so that she doesn't have to worry, And let's see. That's also an asset that's growing. At the end of 2018, we ended up moving out of the condo we bought, turned it into an Airbnb, and I hired a different manager. And in 2019, we sold that property to that manager to buy this one, which is a 2-bedroom. So we were living in a 1-bedroom. We moved into a 2-bedroom. So it's pretty cool to see the progress of change. And we just moved in June, or the last day of May, really. And so that's where we're at. So there's a lot happening, a lot changing. And I wanted to share this story with you just to show you what's possible. You can be really bad with money, have multiple debts. Like I had so much debt, right? And you can turn it around. And there are certain things you can do to fix it, basic principles. So I'm going to share with you some. If you want to know more, go to my blog, yesfinanciallyfree.com. Underneath this YouTube video, there is a link to go directly to the blog. I also have updated my blog so that now people can actually watch live. So if you're on my blog, you got my email list, then you are on my blog and you can actually see this live as I'm doing it. So if you're not on my email list yet, go to yesfinanciallyfree.com, put in your first name and your email address, and you will be on my email list. Okay? So I just wanted to cover all of that good stuff. So that's my background, and today we're going to talk about a really good topic, and that's 7 common investor mistakes to avoid. All right, and this is inspired from the book, The Random Guide to Investing, as well as a book from Robert Kiyosaki, Who Took My Money. All right, so we're going to talk about some really good things, and I want you to learn from your lessons. I did a lot of these investor mistakes myself. So I completely understood when he talked about them. I was like, oh yeah, I did that too. Oh yeah, I did that. So let's begin. So the first investor mistake is overconfidence. All right, you feel like you can handle anything, really. Now most people tend to be overconfident. The only people who don't tend to be overconfident are people who are clinically depressed. All right. Other than that, most people are very overconfident in their ability. And they had a study where they asked a bunch of drivers, I think they were students, and they asked them, do you think you're a better driver than the other students in the class, or something like that, And they would answer, yes, I think I'm a better driver. 90% of them said they thought they were a better driver than the students in the class. So that means they're all pretty confident, right? Well, there's only a few will be the best driver, but they all think they are pretty much 90%. So what does that look like in our investor life? Well, when we go into the stock market, we get overconfident, like, oh, we can make it happen, or forex trading, or what is another one? Real estate investing, right? Hi, welcome to the live. Let me know your name, where you're from. So people will you go in with this overconfidence. This is the first investor mistake. You think that you know everything, think you can master it, and you might not do the proper preparation, or you might just make mistakes because you just think you do. You're very confident about it. So I was doing options investing in 2018, just last year, not that long ago. And I was doing well in the beginning, right? And then the stocks that I was doing options on, their status changed for reasons that are not really predictable, but there's nothing really predictable about the stock market. Yet, because I had success, I thought I would always have success. And then I kind of bombed miserably. Then I bombed again. So I ended up losing thousands of dollars, over like 15,000 or something. A lot of money. And I'm still feeling it today. Still in my soul. But that's overconfidence, right? I became overconfident. And there's no real skill. I mean, you cannot predict the market, and that's what Malkiel talks about. The market has a lot of things going on in it. You don't know when some random thing is going to happen, like the CEO of some company is embezzling something, and you find out, like, how would you know that, right? So there's random things that happen. Maybe war breaks out with China and that will disrupt things, but who knows? You cannot control that, and in the case of a stock moving up or down, sometimes an executive just has to do a really nasty tweet and then everything goes to in my case. Oh, it's funny. So how would you know that? So that's overconfidence. So when you start investing, be aware. To solve the problem of overconfidence is to be aware that you might be being overconfident, and just understand that, investing is a skill, and make sure you know what you're doing and understand that might be a problem. Okay. Overconfidence. Okay. So the next, let's see, I can get it right here. The next one, besides overconfidence, if I can find it. I was actually doing, herding. Herding. That's a good one. Okay, herding. What is herding? Follow the herd, all right? Second most common mistake is we follow the herd. We see a trend and we want to jump on, right? And Malkiel talks about back when they had this tulip craze, right? And this is from his book, The Random Walk Guide to Investing, 10 Rules for Financial Success, okay? And he talks about an example where tulips used to be the rage for the Dutch. They were like so into tulips. They were in the speculative bubble, and they were just buying a ton of tulips. And then at one point, it just burst, right? But everyone was doing it, like getting on this tulip craze. Then there was the tech stocks, right, of the dot-com bust of 2000, 2003, right? And then I guess during the real estate crisis, everyone wanted to buy real estate. I suppose that's what caused that. With no money down and no idea how to pay, no real look at the future and interest rates and adjustable arms. And so, and thinking property values will go forever. So that was also a big one. So this is herding. Herding mentality means that you see a trend and you just want to jump on, okay? And you have to be careful not to just be investing because everybody else is doing it, right? And he has something interesting here where he talks about if you do things by chance, right? You're just in the market by chance and you're flipping coins just to see if the market will go up and down. You're going to be right a lot of the time because it's 50% chance, all right? And people also are that way. They look at things and they see things succeeding, and what we do is we think it'll go on forever, but by chance it might go on for a while, but then it will flip back. So there's a lot of interesting things about chance. It's really interesting, and Chance often will give you long, if you just flip the coin heads, tails, heads, tails, if you do it just randomly, you're going to get like tails, 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 heads, 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 heads. You might get something like that, right? And we don't think that because there was an experiment this woman did where she had everyone flip coins. She had them write down pretend flips, like pretend you flipped, write down your outcomes, and then one student actually flipped and wrote down outcomes. And she could always tell who the actual flipper was because the actual flipper would put more heads in a row and more tails in a row. And most people, when they think random, they think it switches back and forth. So if you see something that's on a steady pace, it can very likely just be chance, right? So be careful. If the crowd knows that something's a good deal, be very, very careful. All right? People will take greater risks with coin, right? I know people who second mortgage sold their houses, took equity out to buy Ethereum mining machines, digital currency. And then it crashed. Now, I think it might be going up again. I don't know. But the point is, you have to be very careful, especially with investments where you really don't know. I mean, everyone knows digital currency is hugely, hugely risky, right? So that's hurting. The third investor mistake is the illusion of control. What is the illusion of control? It means you think that you're in control when you're not, right? And especially in stock market investing, you're not in control, right? This is somebody else's company, right? And they're running their business. You don't control that business. You have no say in the business, right? So you really have no control over the stock price. You have no control over the earnings, over the dividends they declare or don't declare. You just don't have control. But when you start investing, you feel like you have control because you're picking the investments, right? But what if the investment starts losing? A lot of people will leave it there longer because they feel like they are in control. And if they see something that's doing well, the opposite, they'll sell it off. And they'll see trends that they think are there, but they don't exist. They're just looking at flips on the screen like, oh, I see a pattern. I know someone like that, actually. He's often seeing patterns. Always seeing patterns. So there's this illusion that we are in control of things that we're not actually in control of, right? And we tend to believe that events are more predictable after the fact than before the fact. After everything's happened, we're like, oh, we could have predicted that. That's not true because before it happened, you didn't. So there's a lot of things going on in our mind. Hindsight, that's called hindsight bias. When you believe that you could have predicted an event that happened. And then because of that, you feel like you can control your investment future because you'll be able to predict the future, right? Even though you can't predict it. And that's just hindsight, right? Similarly, investors attribute any success that they have or that some fund manager has in picking stocks to brilliance rather than luck. Whereas if you just had dumb luck, the same amount of fund advisors that are actually successful is the same as chance, So, it's hard to say, are they really that brilliant or are they just lucky, right? So that's the thing about and I've been guilty of that. I felt like I was in control of various different investments. And when they weren't doing well, I would leave them there. Because I did the choice. It's funny. Okay, this leads to the third one, loss aversion. Investors don't want to lose money, right? We really don't want to lose, yeah? So this is why he says, if we're more distressed about losing than getting, most of us. So if we see our stocks going down, we might sell them to stop the loss. Where if the stock is in a company that's profitable, there might not be a reason to sell it. Now, if the stock really is going down because it's like Enron, Lehman Brothers, WorldCom, all these dying companies, then you really need to get out. And a lot of people don't. Because when they sell the stock, it means that they lost money. And I'm totally guilty of this. I have stocks right now that, are not the best performers, and I keep them. I keep them anyway. Isn't that funny? I don't know if it's funny, and it's because I know that if I sell it, then I've lost, and then I have to admit that I lost. And it's just no fun to admit when you lose. Now, when a stock's going up and you sell it, then you feel like, oh, that's great. I'm a winner. I succeeded, even though you might not want to sell your winning stocks. I want to keep them because they might keep growing, right? So there's a lot of things that loss aversion does that makes investors make mistakes. So if you're keeping your losers and selling your winners, overall you're going to do worse in the market. You're going to have bad returns. Yeah. But that's loss aversion, and I'm so guilty of that. Next one. He calls it other psychological pitfalls. All right. This one, he has 3 in here. All right. The first is susceptibility to hot tip investing. Right. I heard a hot tip. Right. This company is going to do some major new innovation, or whatever. There's a hot tip. I heard this company has a product that will cure cancer. Whatever. Some hot tip. You do some kind of hot tip investing because somebody told you something. And he recommends never to follow hot tip, because the only really good hot tips out there, if there are any, would be for very high-end people with lots of money to invest. So if you hear anything, it's not really good investor advice. It's just somebody talking about something, and it's not going to help you. So do not ever buy hot tip stuff. And this happens all the time. Okay? All right, gin rummy behavior. Gin rummy is a card game. So he's saying you cannot switch your fund. Don't go around looking at one fund and another fund, and you're like, oh, this one did better this year, I'm going to move it there this year, or this one did better last year, I'm going to move it around. Don't be doing all this moving your money around between funds. And the reason, or stocks or bonds or whatever, the reason is every time you move your money, you incur a transaction fee because someone has to move it for you, right? So you pay. And the transaction fees eat away from your return. So you end up doing all this moving around. And plus, you don't even know, just because they did well last year doesn't mean they'll do well this year. You're moving around isn't necessarily effective, right? So he's saying, don't be doing that. If you're going to buy, he recommends you just buy a really broad index fund that covers all the stock market. Then you don't have to change it because it's all the stocks all together in one place and all the bonds in one, and just stick to your plan and don't be moving stuff around because that's just expensive. The next one is believing in foolproof schemes. Like you hear something like this is guaranteed, we know that it's going to go up. Nobody knows. Okay, nobody knows if the stock's going to go up. Right? I'm going to tell you that right now. Nobody knows. There's no guarantees. Right? And this I learned from Who Took My Money, Robert Kiyosaki's book. He talks about how there's no guarantees. There's just no guarantees, right, in the stock market. This is the book that I'm referring to. You can ask your broker, if the stock goes down, I lose money. Will I get my money? You guarantee that, and most likely they will say no. Okay, because unless they're an insurance type of insurance product, but they're going to say no. All right, so don't believe it. If someone tells you that you're going to get your money risk-free, guaranteed, you really have to be wary of that and probably avoid that investment because they're not being realistic. Of course, you have to look at what the investment is, but in general, that's the truth. Ignoring costs, the next mistake. Okay, so we did 1. We did overconfidence is 1. Hurting is 2. Illusion of control is 3. Loss aversion is 4. Other psychological pitfalls is 5. All right. And then the next one is ignoring costs. Number 6. All right. When you ignore costs, right, and just invest in funds. I had a friend who invested in a fund. It had a front load sales chart. So he had to pay a percentage of all of his invested money up front just to put it in there. Why? Why would you do that when index funds beat the market more than money managers? Why would you pay someone sales looking up front? A lot of people ignore these costs. They think, oh, I need to pay to do this, only because they don't know how to invest themselves. And the great thing is, I did a blog last week, and if you go to my blog post, you'll see, and this book tells you how to invest directly with places to get funds. You don't have to work in brokers. You can avoid all these sales charges. So I like this book. It's very, just do it yourself. Fire your money manager. So you have to check costs. You have to find funds that have very low management fees. All right, this is extremely crucial. Change in percentage of fees can reduce your investment income by half or more. All right, that's a big difference. Okay. Getting entranced by new issues, number 7. IPO, initial public offering. Right, when there's a new company, they offer, you can buy their stock, and they need funding, and you can get a part and be part of their company, ground floor stockholder kind of thing. And he says that IPOs, if you invest in IPO, it's a money losing strategy, because that he said not buy IPOs at their initial offering price, and I should never buy an IPO just after it begins trading at prices that are generally higher than the IPO price. Historically, IPOs have been a bad deal. 5 years after their initial issuance, researchers have found that IPOs underperformed the total stock market by about 4 percentage points per year. Okay, so if you just invest in IPOs, you'll be losing. Instead of just doing index funds and just leaving it, if you do IPOs, you'll be losing 4% a year, and that's a lot. That's huge, because it's just dropping 2% on an investment, cut it in half. 4%, like, you got nothing left. So IPOs, not a good investment. Now, I know a lot of people are into IPOs, very exciting IPOs, but it says avoid. So there you have it. 7 common investor mistakes. I hope you guys have a wonderful day. We're going to have more great content coming up. I'm going to end this live broadcast. I'm going to go live on Instagram next. So feel free to join me on Instagram. Eventually, I will make it back to Periscope. But I want to appreciate you for being on YouTube, being live, being on the blog. So appreciate you, and we will go over more great information next week. And to find out what the topic will be, get on my email list. I emailed my email list before I did these lives today. And you can do that by going to the blog, yesfinanciallyfree.com. I have it right here. Yesfinanciallyfree, and then put .com at the end. Yeah. All right. Have a great day. See you again next week. Aloha. Share this with your friends and followers, and subscribe to the email list. Bye-bye.